All right, welcome to another episode of the Accidental Landlord. Today we have Megan Destito, who is with Southern California Exchange Services. Megan, welcome to the show.
Thank you. Happy to be here.
Yeah, we're happy to have you as well. Why don't you take a minute or two to just kind of introduce yourself to our listeners, tell them a little bit about who you are and what you do.
Sure. So my name's Megan Destito, and I'm the owner of Southern California Exchange Services, and we are a 1031 tax-deferred exchange company. So we specifically specialize in documenting 1031 tax-deferred exchanges, making sure that if a client gets audited for whatever reason, that legal documentation is in place, and mostly, and most importantly, we securely hold their funds when they've sold an investment property. So that's what I do. And so I've been in the business probably for about 13 years. I started out of college back in 2000. And so I did that for a number of years. And then the recession happened and life took a wonderful turn and, did other things and then got back into it just because I realized there wasn't a local competition. And so I really started to hit the ground running back in 2019. So I've just gotten, that's kind of my background.
Gotcha. Perfect. And for our listeners' sake, you're essentially in our backyard. You're in Camarillo. We're in Ventura.
Yes.
So we're
sorry.
in the same area. Oh, it's okay.
Yeah.
But to get the conversation started, let's take it down to like kindergarten level of what is a 1031 exchange, because obviously it's a real estate thing and investment property, but why don't you kind of lay the groundwork for our listeners on what these are?
Sure. In simplistic forms, the 1031 exchange stems from the Internal Revenue Code. So it's the tax code, and it's specifically Section 1031. And it allows real estate investors, people who own investment property, the opportunity to defer paying any capital gains tax when they decide to sell that property, as long as they reinvest those funds into another type of investment property that's equal or greater in value. And so it comes with many requirements and timelines that they have to abide by. So there's several nuances that they must follow in order to defer all of that gain.
Why are we trying to defer gain? Because I think our listeners, for the most part, are accidental landlords. They're generally not professional investors. So a lot of them, their one and only investment property was their main house where they lived in it, or they inherited it, which I guess wouldn't be their primary residence. But let's just say that the scenario is they are living in their house, they get transferred out of the area and they turn it into a rental. Because in regular world, if you're married and you live in a primary residence, you have a capital, you're exempt from a certain amount of taxes. So why don't we speak to that? Correct. And then what happens when you're no longer exempt or it's not your primary residence? Why is what you do a big deal, I guess is a better question.
It all boils down to taxes. So the majority of my clients, their main goal is to defer paying taxes, and that's on the gain. So if you inherited a property or bought a property, that's called your basis. And so any improvements you do to that property adds on to the basis. It gets depreciated over time. And so if you decide to sell that property, the profit that you've made from that basis is taxed. It's taxed at a state level, it is taxed at a federal level, and it's also taxed for depreciation. So it's basically like in California, it's almost 40% that you'd be paying on that amount of profit. But a 1031 exchange allows you to defer all of that. So you would never pay taxes if you reinvested all those monies into another investment property that's equal or greater in value. So it's a fantastic tool.
Yeah, so essentially, like if we use an example, let's just say someone bought in our area, they bought their primary residence, 3 years ago for $600,000, and now it's worth $1 million. They turn it into a rental, and they've lived there past the time that they can claim those exemptions from selling it, so it's truly an investment property. So they have, for the sake of the argument, let's say they have a $300,000 gain. If they're going to save 40, if they're going to pay taxes on that, I have to use a calculator because I'm not
a
math guy. So that they're looking at a $120,000 tax bill that they're literally going to write a check to the government. So if they use this 1031 strategy, they're not paying that. Are they ever paying that, or what does that look like?
So well, if you do an exchange, you can continue to do an exchange over and over and over again, as long as you're making sure that you're holding on to it to at least 2 years before you do another exchange, because you want to make sure that you look like a long-term investor in the eyes of the IRS, because that's who's benefiting from the exchange, right? But you can continue to exchange throughout your life until you die. So they term the phrase swap till you drop. So that's kind of what that is. And so if you decide to sell the property and not do an exchange, that's when you're going to be paying the taxes.
Gotcha. I know from my personal experience, I've done some exchanges, and starts to get complex, because when you exchange, so like I started with just one house in our area, and then I exchanged into multiple houses out of the area, and then that exchange money kind of follows that property, right? And then if I do another exchange, now we've got exchanges on top of exchanges, and it seems like it gets really complex quickly, which is why we need someone who knows what they're doing, right? Someone who has services like yours. Is this something? Go ahead. Yeah, go ahead.
I mean, what I do specifically to handle the 1031 exchange, but you also need to make sure that you have an accountant who is familiar with reporting 1031 exchanges, because, I'm not an accountant, but I've worked beside so many that I know enough information to make me dangerous. And so my understanding is that the basis that you initially start with is being rolled into the next property. And so if you exchange and exchange and exchange and eventually sell, your gain isn't just from the selling point from your last purchase. It's like falling back to when you initially started that exchange. So it's significant. It's significant.
Yeah, it's almost like once you start, you can't stop. Or if you stop, you're really going to get hurt from a tax perspective.
Yeah, or you kind of start branching out and buying multiple properties so that it reduces that gain, because it's spread out amongst multiple properties versus just always putting it into one.
Yeah.
So
what are some things that beginners need to know about these exchanges that maybe you see common mistakes or misconceptions about?
I think the most important is the timeline. So when you're selling that first investment property, they call that your relinquished property, because you're giving it up. That from that moment, you have 45 days to identify replacement property options. So that means properties that you think you want to buy. You don't have to be in contract. It just means that you're kind of giving me an indication, but really the IRS, a letter of intent, because they want to make sure that they know that your intention is to buy an investment property and to hold on to it long term. So if you don't do that within the 45 days, you're done on the 46th day. And so the monies are returned to you. And if that investment was in California, I'm automatically withholding 3 1/3% and sending that to the franchise tax board, because that's what escrow would do. I mean, we use escrow here in California, but that's what escrow would do if you were just selling that property outright. So the first 45 days is absolutely crucial. And I don't think most people understand how stressful that is. So if they've never done an exchange, they think that they can find properties easily. And in this ever-changing real estate market, that's very difficult. Yeah. It's very difficult.
Do you have to buy one of those properties you identify, or could you identify some and then end up purchasing one that you didn't identify?
So there's a thing called safe harbors. So the safe harbors is you're crossing your T's and dotting your I's. So like I said, the importance is having that letter so that you can continue on with the exchange. And by continuing on, it means that you have an additional 135 days to purchase something from that letter. But there comes times, especially again in this ever-changing market, where you're still in a multiple offer situation where your intention is to try to buy something from that list, but maybe you're past that 45 days. You need to decide, are you going to take a risk and purchase something else that wasn't identified on that? Because the risk is that if you were to get audited by the IRS, they will say, okay, so I saw that you purchased this property, but I see that it's not properly identified. So can you explain why you did what you did? So if you have a clear paper trail to show, hey, my intention was to purchase this property, and so I wrote offers on all 3 of these properties, and we didn't get it, and so I went with my next best option so that I could try to satisfy my exchange. So I feel like if you had a very good solid paper trail, then more than likely the IRS would uphold your exchange versus overturning it. But again, that's kind of case by case. So,
Gotcha.
I mean, that it's the risk.
Yeah.
But if you don't have that letter, you can't take that risk.
Yeah, for sure. I know the one thing that I don't like about 1031, I love that we can defer tax, and that's clearly the number one benefit. What I don't like about them is they sometimes force people to make bad decisions, right? So like to buy deals that they wouldn't otherwise normally buy because they're trying to satisfy the timeline constraints of the 1031.
Right.
Have you weighed that? Like, I mean, it depends on how bad of a deal you're going to buy and how desperate you are, right? Like, obviously the benefit is the tax deferred side, but if you're buying something that's going to be, you know, an anchor around your neck, then maybe the tax benefits don't matter if you make a terrible decision. Or do you see people struggling with that? What's your experience with that?
A little bit. So once somebody does an exchange and they get into the property, unless they're doing another exchange again, I kind of don't hear from them. I don't really hear the good, the bad, the ugly from an investment that they weren't happy with.
Gotcha.
But I do know that if you're about to do an exchange, for those, I think right now, other more savvy investors, not the beginners, won't enter into an exchange unless they have a good idea of where they're investing. So, and for the newer investors, I agree. I think that they get caught up within that 45 days and then they end up settling for a property that they probably wouldn't want. But there are other options out there where I think that most investors aren't thinking, I think they're just thinking residential. So there's a lot of opportunity in the commercial real estate space that's actually more affordable than residential. And you can buy pieces of different types of property that's either in a configuration called a tenant in common configuration, or it's in this other configuration where it's within a trust. And so you're buying pieces. And so, I mean, you can buy in for like $50,000 or $100,000 and it's passive income. So for those type of investors who are kind of panicking, I kind of mention these type of investments to them because it's passive, and it's like some of them are securitized real estate transactions. So you're kind of just sitting back, eating bonbons, but making money at the same time. And some of them, you're only in it for maybe 5 to 7 years. So you can kind of put your money here until you figure out really where you want to invest down the road. So
Gotcha. And you help guide the people you work with into these options or point them in the right direction?
I point them in the right direction because in the TIC industry, they're working with commercial brokers. And in this trust, they're called Delaware Statutory Trusts or DSTs. That's through a financial broker, a financial advisor, because they have to hold a Series 7 or whatever license. So that's not what I do. So I kind of say, if you're interested, these are the people that you should talk to. So I act like a middle person for that. Yeah.
Gotcha. Who you mentioned dealing with savvy investors and dealing with beginning investors. What is obviously, I mean, I think we could all just assume the differences, but what is the majority of your client base look? Are they like first time people, or are they people who are doing this over and over again, or what does that look like in your business?
It's definitely a combination, but I would say that mine are first time investors. They're mom and pop investors who, have been sitting on an investment property and just learned about what the realtor told them what a 1031 exchange is and that they should contact me. And so, yeah, it's definitely a mix, but.
How much of your time is spent on educating them? I know you have a pretty robust social media, which I think is great. Do you find that they require more education than someone who's done it before? Or?
Absolutely. So because it's a lot of information and it's so overwhelming. So it's more hand holding for the first time, but I like that because I want them to know what they're doing. I want them to feel knowledgeable, but I also want them to feel comfortable working with me because you have to give up, control. So you don't have access to your monies when you're doing a 1031 exchange. And some investors, when they hear that, they will not even do the exchange. They will pay the tax. So it's definitely a good mix, an interesting mix of.
Yeah, it is funny, like what actually motivates people, like someone that's willing to pay a bunch of money to the government because of this lack of control that they get. I have a question surrounding there's this 2 of the last 5 years, which I'm sure you're familiar with. Like if you have to live in the property 2 out of the last 5 years to claim, I forget the name of the exemption, but it's whatever the exemption is from living in the primary residence. Like if you sell it, you don't have to pay capital gains tax. I think it's up to 500,000 for a couple. So this comes up in our business, and just so you're in the loop, we own a property management company in town in Ventura, and we deal primarily with accidental landlords. Because it's so expensive in our area, you don't have a bunch of cash flow investors running around like you do, like say in Cleveland or the Midwest somewhere. So this always comes up because inevitably they move out of their house that they were living in, and that 5-year clock starts. And when that time comes, they're faced with a decision, which is, do I want to sell this house and not pay the capital gains on the first 500,000, or do I want to let it actually turn into a rental property and then have to pay tax if I sell it down the road? And I think it really is a bigger decision for them. I kind of fell into this rental property, and it's working. I may love it, I may not, but I am really being held to the fire with this 2 out of the last 5 year rule. And that obviously is directly related to your business, because the second they pass that 5 years, now if they want to avoid tax, they have to come see someone like you. Do you get involved in that conversation, or is that a conversation you have with people, or is that probably by the time they get to you, they've already kind of made a decision, or what's your take on that?
Well, we're talking really about two separate parts of the statute. So you're talking about your primary residence, which is under Section 121. So as long as you've lived in the property for 2 of the last 5 years, and you're selling it, then you get that exclusion. But if you're converting it to a rental, then you want to make sure that you look like you're a long-term investor. So if you're selling that, then you want to make sure that you're renting it out for, I say I'm more conservative, and I say that you've at least owned it and reported it as a rental for 2 years. But there's other advisors, because that's really what it boils down to, is who you're getting your legal advice from. And they'll say, no, at least 1 year. So for those new investors, once they convert it to a rental, they're no longer talking about a primary residence. So it's completely two different conversations.
Sure. So like in the example I'm talking about, they live in it for 2 years, but more than likely for 15 or 20 years or whatever they lived in it. The second they move out, they only have 3 more years to qualify for that 2 out of 5 rule. And when at the end of that 3rd year, they're coming to us basically and saying, what do I do? I know this is the thing. And that's why I was just bringing it up. But in reality, by the time they get to you, that's not even it's already been decided at that point. So I think on our end, it's still up for debate on which way they're going to go. But by the time it gets to you, probably not as much. So I basically answered my own question while I was talking to you about it.
That's right.
Okay, let's talk about. There's obviously there's a ton of nuance involved in 1031s, and it's not we haven't even scratched the surface of all the different things that go along with it. There's something that I've seen a lot of people talking about, and I don't know the terminology. I want to call it a lazy exchange, but it's like where you just pay the tax and then you purchase another property and you do a cost segregation, bonus depreciate it, and you get the same net effect at the end of the year. Are you familiar with what I'm talking about?
No.
So if you don't do a 1031, let's just use the example. You have a $100,000 tax due. You sold an investment property, but you didn't do a 1031. So, and you do it in the beginning of the year. Well, before the end of the year, you buy another investment property, and then you take advantage of the bonus depreciation, which is something that is being phased out over time. But you bonus depreciate that property $100,000 or over $100,000, and you essentially wipe out any tax due from the previous sale. I think they call it like a lazy exchange, or there's a term, and I don't think it's actually lazy, but something along those lines. But it's basically a way to avoid tax without doing a 1031. But it, again, gets you in this trap of you have to keep buying real estate to depreciate it to offset the tax. But if they're talking to you, that's not the route they're going. Or I guess they could if they decide not to ultimately do a 1031 after they talk to you. But
right. I mean, I think that there's alternatives because in the exchange, like if you're doing strictly a 1031 exchange, of course you have to reinvest it into another investment property, but there's other avenues out there where you can technically do an exchange into, it's called a 721 upreit. And so basically it's kind of like the end of your exchange journey, if you will, where basically you can do a 1031 exchange into this real estate property, but then that is converted into a REIT. And so once you enter the REIT phase, because they don't qualify technically for 1031 exchanges, you're kind of done. So it's another way for you to invest in something and be done. But there's other things that you can do, which is like an installment sale, or you can buy other types of investments, like you mentioned, where you can mitigate some of the capital gains tax by not doing a 1031 exchange. But that's out of my scope. That's not my conversation that I'm having. And of course, when my clients are calling me, their main goal is to, of course, do the 1031 exchange. So
Gotcha. What about, because I've had this come up multiple times in our business, they want to sell an investment property and exchange it into a nicer house where they live. Is that allowed?
First, you need to make sure that it's a rental so that it satisfies the exchange. But yes, over time, you can convert that and have it become your primary residence. So I have had people utilize the exchange to help them with retirement. So they have like this 5-year plan, and they know that they want to do the exchange and buy their retirement home. And then they rent it out and then eventually move into it and convert it. And it becomes their retirement home, their primary residence. And it's something that they would keep and then eventually pass away, and then their kids would inherit the property. And once they do that, then they will get the step up in basis. Mm-hmm. And if they were to sell it, then they wouldn't pay tax. So, there are people who utilize the exchange for something along those lines.
They just have to be patient, essentially. And you're saying 2 years is what you recommend of having it as a rental? Yeah.
Yeah. So I just think the longer that you hold on to it, the more you don't have to convince the IRS that you're a long-term investor. Because if you fall below that, the IRS could deem you a dealer of real estate. So we're talking people who flip properties. Mm-hmm. So there are people who do that and want to try to get away with the exchange. And technically, it's like a red flag.
Let's talk about that. So, what is your exposure to having clients get audited or seeing people who get audited and having the 1031 like called into question, or what is that?
I'm knocking on wood because it's never happened with me. So please don't jinx me.
No, we won't jinx you. It's got to be a thing though. Like it happens to people, right? Right. Hopefully that never happens.
To what extent? I don't know. So I've never been called into question.
I mean, the reality is if you get called in, if it happens, you're talking about a significant penalty. Like just to pay the tax is going to be a huge
taxes and interest. Yes. Yeah. So I know that an accountant is filling out the tax form 8824, which talks about the specifics of the 1031 exchange. So in that form, they're asking when you initially bought the property and when you relinquished it. So they automatically on the first page know how long you've owned and held that property. Mm-hmm. So if you're doing it for like 3 months, that's automatically raising a red flag that you are not a long-term investor. You are a dealer. So
yeah, definitely not a good idea. I think I kind of agree with you. I'd rather be conservative on these things and keep myself safe than having to pay back a bunch of tax. And I'm sure they're going to penalize you on top of that and probably audit all your other stuff for a couple of years while they're at it.
Right. Yeah.
Okay. Very good. I think this has been good. What if somebody is looking to work with a qualified intermediary and a service like yours, what advice do you have for them as far as how do you do due diligence on who you're going to work with? What are some red flags you should watch out for? Like, what does that look like?
It's really the main crux is that the qualified intermediary is basically doing everything on the up and up. So as long as they have proper documentation in place, and I want to say that you can't just hire anybody to document your 1031 exchange. It's specific verbiage that has to be in place, and the documents have to fold in with that transaction. So you can't hire a relative to call it an exchange and hold the monies for you. That's a disqualified person. It will not fly in the eyes of the IRS. So you want to make sure that you're using a company, a person that's specifically what they do, just like myself. So we have legal documentation in place that folds in, and we also are making sure that we securely hold the funds. So the funds have to be separated, not commingled, in an escrow trust account. So you want to make sure that that's who you're hiring to do that, and you want to make sure that that they're protected.
So this is not something that you can go online, research, and do yourself?
No, you can't. So I had somebody call me who said that they found a company up in, New England that would do the exchange for $200. And I said, I would be leery about that company. You get what you pay for. So, and
100%. What do these services typically cost?
Well, we're not a fully regulated industry in that regard. So the cost will vary, I think, across the board. I would say probably on average $1,000. So for me, I'm more of a tiered structure based on the value of the property that they're selling. So my fee will start at $850, and my highest fee for a deferred exchange is $1,250. So
gotcha.
Yeah.
So not peanuts compared to what you're going to save in the form of deferring the taxes.
Thank you. Yes, exactly.
Let's talk about laws or politics, I guess, for that matter, because there was a time, obviously politics is, not something most people want to talk about, but in relation to 1031s, I think it was the current administration that was talking about getting rid of 1031 exchanges. And obviously that's a huge deal for real estate investors. And this is your world, I'm sure it's probably not more relevant to the people who do the exchanges. I don't know if I said that right, but anyhow, you get the message. What did that look like? I mean, I don't know if it was political posturing or if they were actually going to get rid of it. I know it would be a huge change, but you're tied into the industry and what's going on there. But where are we at with that?
It's always under threat, I feel, especially like the last definitely. It's almost like every year, every election that comes up, local, statewide, and federal, it comes into question. But it was very close. I was actually very scared that it was going to pass. And I think that there are enough. I think what people don't realize is how much the 1031 exchange industry affects the economy. I mean, it helps keep real estate going. It helps keep escrow going, title going, attorneys, there's construction. There's so many things involved with real estate transactions, and the 1031 exchange is a huge portion of that because it's a motivator for people to relinquish a property and buy a new one. And so there are so many companies, people who are out there lobbying to save the 1031 exchange industry. And I think that eventually, the exchanges have been around for over 100 years. So people have had the opportunity to defer paying 100% of the capital gains tax on investment properties for over 100 years. That's kind of crazy that aspect hasn't changed. So I feel that I think it'll continually be brought up. But with this last election, they were trying to do away with it completely. And I think that instead of doing away with it completely, they will put a cap on how much you can actually defer versus giving it 100%, So I think that's kind of where it might be headed if it comes up again and again and again.
It blows my mind because just having properties transfer from people to people and sell for higher prices it's crazy to me because the government wants to generate tax revenue. And I think what they don't like about the deferred exchange is they're not collecting the capital gains tax. But what they're neglecting to see is that they're collecting higher property taxes and all the other taxes that come along with it by these properties changing hands. And if they stop, and make no mistake, like properties will not change hands as much if 1031 goes away. Right. In my opinion, they're going to see a bigger hit on their tax rolls from that alone, which I think is terrible. And not to mention all the stuff you're talking about, all the allied businesses that surround real estate, from construction to the attorneys, all of it. Like there's a huge industry that comes along with it. So interesting perspective. I feel like it comes up every time. And I feel like they just use it to scare the people and use it to gain something from the other side. They'll go, okay, we'll give up the 1031, but we want this, and knowing that they
yes,
probably never were going to get it in the first place. But
I mean, think about how many people in government utilize it themselves. Like major corporations. I don't know. It kind of surprises me that it would even be under threat in just that regards alone. So
yeah, for sure. Well, this has been a great conversation. Anything you want to share with our listeners that we didn't cover that they need to know or they need to be aware of regarding 1031s?
Well, one thing we didn't cover is that there's different types of exchanges. So you can do an exchange where you sell first and then buy later, but you can do it in reverse order. So if you come across a great investment property that you weren't even thinking about buying, and then you realize, oh my gosh, I have an investment property that I could sell and defer the gain. You can do things in a reverse order. It's a little bit more complicated. You can even buy a fixer-upper property. So if in an exchange, you're trying to buy equal or greater in value, but there are times when you find a fixer-upper that if you put a little bit of money, elbow grease, it could have a lot of appreciation like right off the bat. So you can do what's called an improvement exchange. So I can help you buy the fixer-upper first. You can make the improvements to it. Then you can sell your investment property and buy that fixer-upper at that higher value. So there's so many ways that you can configure a 1031 exchange. That's what gets me excited, is because it's not just cookie cutter.
Yeah. Are you finding a lot of people are doing those reverse ones or improvement ones? Or
a lot of them mull it over because they realize that it's an option, but once they realize how much it costs to do that, they kind of weigh their options and figure out a different.
But speak to that. When you say it's obviously different, speak to that. When you say they figure out how much it costs, what does that mean exactly?
So when you're doing the reverse exchange, it's really an entity, an LLC that I have set aside that has never owned property before. It's worth nothing. It's merely just taking title to the property. But you're loaning that LLC the money to buy the property for you in a reverse exchange or an improvement exchange. So legal wise, you're paying for the formation of this entity, the dissolution of the entity, you're paying for attorney's fees, and then the risk involved for me to be holding title to a property that I don't want, if anything should happen to it. So a base fee kind of for a reverse exchange would probably start at $6,000.
Gotcha.
So if you need financing in order to initially have me acquire the property on your behalf, lenders now are very difficult to find that will do it nice and easy. So most of them want it to be a loan for at least $1 million. They'll probably charge you a point or two. Those types of fees are incurred. But then if you think about the big picture, and like you mentioned, how much you can be deferring just on taxes alone, some people feel like it's worth that cost in order to save.
Well, the other thing is you're not forced to make a bad decision on identifying or buying a property if you do it that way as well.
Correct. So You're very clear about this is the asset. This is what we need. This is going to bring us that monthly income. It's in an awesome location. Let's jump on it. Let's not, if we can beat out the other offers, let's do it. So.
Okay. Yeah. Interesting. Yeah. So obviously there's no way we're going to cover everything on 1031 exchanges today, but if our listeners are interested and they have more questions or they're considering doing this, what's the best way for them to find you and get a hold of you?
You can find me on Instagram and Facebook. My handle is at SCES and the number's 1031. You can also call me. So I will always respond to any inquiry. So my number is 805-738-2599, or you can email me, Megan, MEGAN, at SCES1031.com.
Awesome. And we'll make sure that's all linked in the show notes. For our listeners, Megan clearly knows what she's doing, and go follow her on her social media accounts. You'll be pleasantly surprised. She's a bit of a comedian. I always get a good chuckle when I see your posts.
Good.
But absolutely reach out if you have more questions or you're interested in her services. And thanks for coming on the show. Appreciate it.
Thank you. I appreciate that. So thank you.
All right. That was a great conversation we had with Megan on 1031s. So she clearly knows what she's talking about. This is a strategy that will come into your investing career at some point if you do it long enough. It only, it's something that you need to consider if you're going to be selling a rental property, because nobody wants to pay 40% of the gain to the government if you don't have to. And when you don't do that, it allows you to utilize more of the capital to buy more property, which 40% can help you either buy another property or a bigger property or have a lower, loan to value on the property you buy. So it's a big benefit that helps real estate investors out, which, as we were talking about at the end there, helps the economy in general. And the 1031 code is something that the politicians, depending on what side of the aisle they sit on, they want to do away with. Which would be a shame for real estate investing in general. But make sure you take a listen to that portion at the end, because that is something that will materially change real estate investing for a lot of people. But really enjoyed having Megan on the show. If you're interested in doing this or finding out more, please reach out to her. She absolutely knows what she's talking about. Thank you so much for joining us, and we look forward to chatting and being with you next time.